Welcome back to another episode of Beyond the Sold Sign Real Estate Unplugged. We are your host and favorite realtors, Naya
and Lauren.
And if this is your first time joining us, welcome. We are so excited that you're here. Now let's get into this week's story.
A friend of mine recently told me about a conversation she had with her coworker. He had bought his house a few years ago, and at the time, he was just happy to get approved for a loan. He didn't really shop around for lenders or try to negotiate a lower interest rate. He just went with whatever bank offered him. Fast forward a few years, he started realizing just how much money he was paying in interest. He saw a breakdown of his mortgage and was shocked. He was going to pay hundreds of thousands in interest over the life of his loan. He felt stuck, thinking there was nothing he could do about it. But then he started hearing about ways homeowners could lower their interest and save money, even after buying a home. He looked into refinancing, started making small extra payments toward his principal, and even switched to bi-weekly payments instead of monthly. In just a couple of years, he shaved thousands off his mortgage and put himself in a much better financial position. His story made me think how many homeowners out there, just like him, are overpaying on interest simply because they don't know their options. So in today's episode, we are going to break down some of the smartest ways to cut down your mortgage interest, whether you're about to buy a home or you already own one. These strategies could save you thousands of dollars and help you pay off your home much faster.
Yes. All right. So before you buy your home, there are things that you can do. The first one is credit score.
Yeah.
Like your credit score is a factor in what interest rates, you'll be offered when you are purchasing a home. So obviously the higher your score is, it'll qualify you for lower interest rates. So if you're able to work on paying down some credit card debt, be sure that at the least you're paying your minimum payment on time, not missing any payments, and avoid opening new credit lines also, so that you can, really just keep your credit score in tip-top shape.
Yeah. And the lowest that I would suggest, like, for a credit score, I mean, I really don't want to see anything less than 680, but
yeah,
I mean, to get you like one of like the best interest rates, I mean, I feel like 680. Yeah. I mean, I know you can go lower, obviously. I just feel like if you want
a favorable interest rate.
Yeah. 680. I really don't even want you in the sixes, but 680 I would be perfectly fine with. So, and I think most lenders would be as well. We just want to get you the best interest rate.
Right.
Yeah.
The second thing is know that it's okay to shop around for a rate. So like the individual in this story, went to the bank, went to his bank and said, okay, and didn't shop around. So talk to two lenders at least, and then maybe also see what your credit union or something like that will offer you, so that you can have something to compare it to and choose what works best for you.
Yeah, please shop around. That's so important that I don't think some people realize.
That they can
shop around. Like, oh, well, doesn't it know? And then when you are shopping around, do you want to talk about like what happens with the credit?
Oh yeah,
bills?
So you have help me. Is it 30 days?
Yep.
Okay, I was like, it's just 30 days. Yeah, you have 30 days where you can shop and have your credit ran, and it won't impact your credit score negatively. They'll know that you were shopping for a mortgage rate at that time. So you'll have that window from when you first got the first one pulled to get another one for 30 days.
Yep, they will only count it as one
hit.
Inquiry. Yeah, one hit, and then that hit may be like 5 points, but it'll go back. Like it doesn't take that long, but it will go back. But just like shopping for a car, when they're like running all of those, and you're like, oh, well, which one's the best?
Like, wait a
Why I got so many? Yeah, so you'll see them, and you can do the same thing with the house because they want to make sure they're very buyer friendly. Like when you're a buyer, it's very buyer friendly where they want to make sure that you are getting the best rate. So shop around. It doesn't hurt at all. And they're going to ask you all for the same information. Like all the lenders are going to ask you for the same stuff. You might as well just go ahead and do it. You got them all right there in the little folder. Apply. And then if you want to do more than 2, go for it. We normally will provide 2. But like Naya said, you also have your credit union, your bank, whomever, your parents, you, somebody, your sister, whatever, whoever you want. But shop around, and you do have those 30 days, and it only hits your credit one time.
Yes. You could also increase your down payment. So obviously, the more that you put down, the less you'll need to borrow or finance. So that's always an option. And we share, all the time that no, you don't need 20% down. You only need 3% or 3.5%. Pending if you do conventional or if you do an FHA loan. But you are welcome to, if that is what you choose to do, and if you have the extra means to do so, you are welcome to put down more than that amount. But just know that you don't have to beyond the 3.5%. What else would you say they can do before?
You can choose a shorter loan term. So I don't know how many people know this or even want to know this, right. But 30 years is pretty standard. 30-year fix, meaning your interest rate. Okay, so let's start with the year. So 30-year or 15 years. So if you have a 30-year, that's, it's expanded out into 30 years. You have 30 years to pay it. The 15-year one is obviously only 15 years, but your mortgage payment is going to be higher because it is only 15 years. So that you want to pay it off much quicker. That's half of 30. So, I mean, that is a lot faster. And then also if you have the 30 years, I guess you will pay less. I guess you will pay
like less with the 15-year. You'll pay less interest overall with the 15
right
year.
Yeah, you would pay a lot less just because it's half of the 30-year. And then you have a fix. There are like different ways that you have a fixed way. Fixed means that your mortgage payments stay the same over the entire term of the loan, whether it's 15 years or 30 years. If you have like an ARM, which is an adjustable rate mortgage, I do not recommend this for anyone, but some people have it. It works for some people, which is perfectly fine. That means, again, adjustable rate, it adjusts. So your interest rate, it is based off where the rates are that year. So when you purchase the home, if interest rates were at 5% and then the next year ends up going to 7%, now you're paying your mortgage at a 7% rate instead of the 5%. So yeah, you have those options, but I would personally stick with a fix.
Yes, I don't want nothing adjustable.
No, I don't need nothing adjusted on me. And I'm like, wait, what happened?
Some people do choose to do that.
Yeah. And that's okay. Yeah, that is totally your choice. For you, yeah. Totally your choice. And then you can also
by the discount points.
Yep, that's a good one. Think about the same exact thing. Yeah, beforehand.
Yeah. So you can buy a discount point, which means that you will pay extra up for a point up front to lower your mortgage interest rate. So let's just say, it was. Let me make sure I say this right. So 1 point will be 1 point. If you're going to buy a discount point, 1 point is 1% of your loan amount, and it'll typically reduce your rate by 0.25. So if you're purchasing a $350,000 home, your amount to purchase the discount point will be $3,500 to reduce your interest rate by about 0.25. So that is an option. Yeah. It can make a little bit of a difference. It can bring you from maybe being in the 6 point something percent to being, 5, 9 something. And hey, that once you add that up, that little, that little bit helps.
That makes a huge difference. And we see that a lot in new construction. They always ask.
Yeah, they're always,
do you want to buy down your points? Yeah, do you want to buy down? You want to buy down? And if you have the cash, like if you know you're walking in and you're thinking about putting, I don't know, 10 to 20% down on a house.
Right. You might as well buy the points instead.
Yeah.
Yes.
Instead of putting that way.
Absolutely.
I would be buying the points.
I'll be buying the points.
Instead of putting less down or more down for my down payment. Use that extra, $10,000 and buy some points down. That makes a huge difference.
Interest rate.
Yes. That makes a huge difference. So those are things before you buy the house.
Before.
Yeah. So there, I guess.
And things that you can prepare for before.
Right.
So like if I'm a be in this price range of a home, I know that I do want to set aside something to be able to buy a point. So now you can, prepare for this ahead of buying the home. So once you've bought the home, if you've already purchased the home and you're like, okay, well, I didn't buy no discount point. I didn't do that. So what can I do now? Because this mortgage is mortgaging.
Don't worry, we got you.
Right. So there are still some things that you can do. One of them is that you can make extra payments toward your principal amount of your loan. And so even one extra payment for the year, not every month, but just one at some point during the year, can reduce the interest that you pay overall and can dwindle away at your loan period, your loan term. And so maybe you might do this by rounding up what your mortgage payment is and make sure that, hey, you make it even to whatever next hundred or few hundred amounts, and make sure though that this amount you specifically put towards your principal, or if you just want to do a chunk of that amount to the principal at some point during the year. So if you want to do it all throughout the year and round up, or if you want to just make a lump sum but it goes to your principal, that is a way that you can shave off your loan term and make sure that you paying less interest over time because you're shortening the loan term.
Because then are you saying like you can like when you make extra payments to the principal, can you take, if you don't want to do a lump sum, let's say your mortgage is $3,000. If you don't want to do the lump sum, can you divide that into 12 months and pay an extra payment that way?
You could.
And then it could just total to the $3,000?
Yes, absolutely. Okay. So whatever, and maybe one day, I don't know, maybe your Aunt Sarah sent you some money and you were like, okay, I'm not going to go shopping, but I'm just going to put this amount towards the principal. Maybe it was $200. Just put it towards your principal. Like, why not?
That is true. Okay. I like that.
But yeah, that's a great too. If your mortgage payment, like Lauren said, is $3,000 and you're like, okay, I'm not going to do that chunk.
Yeah.
But split that $3,000 by the 12 months and put that towards your principal. Just do it. Just do it.
And that could just be your mortgage payment moving forward. Like
right. Maybe you make up a number, for yourself.
And be like, this is my mortgage payment moving forward. And you don't even realize you're shaving off all that interest in the years.
And it's so good, when it like you don't, so maybe it's something that you do on auto pay. You probably have your mortgage payment on auto pay anyway. You can look at your online portal and how you make your payments. So maybe you add something extra to an extra, automatic thing, or you call them to implement that and see how you can add that option. But yes, that if you are already in the home, you can still shave down by doing that.
I love that.
Another one, refinance. Now, if you got a 3% rate, honey,
sit down.
This is not for you. We're not talking to you. Okay. Go ahead somewhere with your 3%. Okay. Good for you. But for the rest of us who did not get 3%, you can, at some point, right? You're going to refinance, obviously, when rates are lower than the rate that than your current interest rate.
Yes.
And not by a 0.25%. It needs to be significant that it's going to make a difference, that you have the equity in your home to do so. So like, yeah, if it goes down a tenth, honey, it's not time to refinance. No. But, maybe it'll trickle down to where it can make sense. But refinancing is an option. So if we do see a significant drop that is significant under wherever your current interest rate is, you can refinance to a lower rate, and that will obviously lower your monthly mortgage costs. Mm-hmm. So again, you'll just really want to be in communication with your lender to make sure that that process is going to be worth it and that it makes sense financially, at that rate to do so. Mm-hmm. But now for the people who were able to refinance when things drop to
that 3%,
that must
good for nice. Y'all.
Good for y'all.
I hope y'all took advantage.
And I hope you did. Yeah. Okay, you had to. Y'all. I know those lenders were calling.
Right, you had to. You didn't sell. You just went ahead and you refinanced. That had to be. And I feel like they should have refinanced and then like, okay, we're going to sell. But now if you trying to sell, where are you going to go to get another 3%? That's the problem.
That's
trying to figure out where you're going to do that. But okay, all right. Eliminating private mortgage insurance.
Mm-hmm. This is
that's big.
It is.
I don't think some people realize. Private mortgage insurance, pretty much what that means is that you as the buyer did not put down 20%, at least 20% on the down payment on your home. So the lenders use it as insurance so that it kind of covers them in case you as a buyer default on your loan. So if you do have private mortgage insurance, which most people do, mm-hmm. and that comes on with a conventional, FHA loan. If for whatever reason you do have that, again, which most of us do because most of us are not putting down 20%, that will fall off at 80%. So when you have paid 20% of your loan and you have 80% left, that private mortgage insurance will fall off. But let's be clear, it ain't just going to fall off. You're going to have to call them and be like, hey, I paid 20%. Now, it may do it for conventional. I don't think it does. It may. Some lenders, they may be honest and say, okay, we're just going to go ahead and drop. You got to call them. Call them and say, hey, I think I may be a payment or two away from paying down to that 20%. My private mortgage needs to go ahead and come off, and they will go ahead and remove it. But some of them are not going to remove it.
So be on top of that.
Be very much so. Be on top of it.
Yeah, so that'll be a nice little bit you can save once you hit that mark. So definitely keep an eye on that and request to remove it so that you don't miss out on keeping a.
Because that could be a good $200.
Right,
that's like an HOA condo fee right there.
Yes,
that's a good amount.
Yes, and then if you really want to be really, really creative, you should take that $200 that you're saving from your private mortgage insurance and put it towards your principal. But y'all didn't hear from me. I'm just saying.
I'm going to do that. That's a really good idea.
Just roll that money that you were already paying to really continue to benefit you. But I hope
that's a great idea. I hope y'all listening. That's a great idea. Yeah. Listen to that and do it. Okay. We're trying to give y'all strategic ways to go ahead and pay this mortgage down faster. Okay. So I got to listen.
And then we talked about this a little bit, with just sliding extra payments towards your principal.
Yeah.
But another way that you can be creative about your mortgage payments is to just set up bi-weekly payments. So instead of doing your 12-month payments, you're going to make half payments every 2 weeks. And that's going to result in that same one extra payment that we were talking about initially. So that'll be one extra full payment per year. And that also contributes to reducing the amount of interest you pay and the length of your loan term. Goodness, all the words.
No, that's a great I do that with my car so I can switch it and do it with with the house.
Yes, and I've been meaning to do it with my car. Yes. So thank you for the reminder. I don't know why
to do bi-weekly.
I didn't set that up.
Oh, now I'm definitely gonna be doing it. And now I'm realizing I'm paying a little bit more monthly. Yeah. I don't know how, but whatever. I'm paying a little bit more. Like the payment isn't more, but I'm paying a little bit more. I guess just how I split it up, like by weekly. And I'm like, I like this. That way I can
get me out of here
fast. Okay. Can I stand a car payment? Jesus.
Get me out of here. So yes. Before you have some things to do to prepare before you purchase a home, and there's things that you can continue to do after you purchase a home to cut on your interest rate, to cut on your loan term. So we really encourage you all to implement these things so that you can get up out of there faster with your loan and cut down on the interest that you pay overall. So thank you so much for joining us for another episode. If you're watching us now on YouTube, be sure that you like, comment, subscribe, and share. You can listen to us on any podcast streaming service that you like. And don't forget to follow us on Instagram and TikTok as well. Have a great week.